I'm here with Marc Thompson. He's the manager of healthcare lending at Bank of the West, and they have been pretty busy in the senior housing and care market. With occupancy finally picking up after about 18 months of either down or treading water, are you seeing more interest in new development for properties?
Yes, we've seen since the summer of last year, we've seen an uptick in requests. We've seen a lot more opportunities come across our desk for construction financing, particularly in the western region where we provide lending. We lend in 19 states in the western region, so it's quite a big territory.
Are there any areas or states within those 19 states, or kind of you're seeing more construction requests?
We were seeing quite a bit out of Arizona, believe it or not, and in Denver and in California. We're seeing quite a bit there as well. We haven't seen much in terms of new requests in Oregon or Washington, but we recently were looking at an opportunity in Boise, Idaho, for instance.
But what is differentiated at Bank of the West in terms of, not many banks like to do construction financing, especially in the last 3 years. You still have. What's different about you guys?
Well, I think we have been in the industry quite exclusively since 2002, and we've learned who to do business with and what kind of criteria we're looking for to qualify borrowers for construction financing. We're looking for, good track record and good liquidity and good recurring cash flow. And I think if we have operators that fit that bill, then we can lend in any market at any time in the economy. And that was the one differentiator about Bank of the West, is that we never shut down. We continued to do business in 2008, 09, 2010. We did construction, but it was interesting because loan demand was so low.
Right.
So we actually had been in application a number of times where the borrower just withdrew from the construction financing, even though that we already had it approved. So that was interesting.
And any property types you prefer? Skilled, assisted, independent, Alzheimer's?
Typically what we do is a campus type independent private pay product. We are looking for independent living, assisted living, and memory care communities. We'll do some skilled nursing if it's part of that, but we will not do skilled nursing on a standalone basis. We just have not been able to get comfortable, nor do we have the staff for monitoring purposes of the Medicaid type receipts. It's just, and Medicare actually as well. So we just we don't have the capacity to really monitor that.
Right. And are you doing any expansion, substantial rehab type of financing, or is that too small unless it's an existing client?
We're doing like the second phase or third phase of a project. So we're looking at those. The rehab, we have a number of those, but what we're finding is reposition rehab are very high risk. And my whole construction career of over 20 years, I've yet to see one that has come within budget and built on time. So it's been even in senior housing, and I keep testing that theory with senior housing, and it seems to be very difficult to overcome the previous management's legacy in the marketplace.
And I assume if you do the second or third phase, that means you've already done the first phase.
Not necessarily.
Really?
Not necessarily. We're actually looking at a project for a second phase, and that project we didn't have anything to do with.
Can you give me a profile of the kind of construction borrowing client you like to have?
A profile. Well, we like to see 4 or 5 communities at minimum that they own. What we found is smaller type operators have had a higher risk profile for us, given our experience with that. And so we're looking at 4 to 5. We make exceptions to that, but we're looking for 4 to 5 minimum. But we do regional and super regionals and large corporation type credits as well. So it really what we're looking for is recurring cash flow, the ability to make payments in the event of operating deficits, and interest reserve, once the interest reserve is exhausted, say the lease up takes longer. And the ability to repay and remargin in the event that that's ever needed down the road. We don't typically do that, and we haven't had to, but we want that capacity.
And when you do construction financing, who is usually doing the takeout permanent financing, and does that have to be mostly committed before you finance it?
No, we do all our construction financing uncovered. But we underwrite to Fannie and Freddie. We always have, and our policy is lined up that way very well. In fact, when Fannie and Freddie loosened up in '07, we were still staying where they were. We've held to that underwriting standard, and now they're back up to their old underwriting standard in terms of debt service coverage ratios and what have you. All our debt is recourse. Fannie and Freddie are all non-recourse, which is, all the risk is building it and leasing it up to stabilization, and then you are able to get non-recourse when you get into the permanent.
So they can't wait to have Fannie and Freddie take it.
They are so incentivized, it's unbelievable. But it actually works out really well, because that's where our risk is, I think, in the marketplace, in this type of industry. It's in the construction and lease-up. So we can't afford to be in this business if we didn't have a balance sheet to depend on to solve the problem. We can't take the losses, because that's the problem with what we have in the banking industry is that we have a lot of banks that are exposed to losses, and they just don't have enough margin to make to overcome those losses.
Now, you said a year ago loan demand has obviously slowed, and some of your clients were pulling out of deals that you approved. With the economy turning, with occupancies going back up, are you seeing more requests for construction financing?
Yes, we are. We're seeing a lot more requests. We're really busy, and we're seeing, all my loan officers are very busy looking at new opportunities.
So what's going to be your big challenge for 2011 and 12?
As a group, it's basically processing what we have and looking at new opportunities and just processing the business. But in the last couple of years, it was more finding new business that was good enough. Now it's we still see we're seeing some credits that are just on the margin in terms of being good enough, but there's a lot more that are that we're seeing that are certainly satisfactory and will work. It's just about processing those loan requests and getting them approved and closing them.
Well, I think with all the pent-up construction demand out there, I think you're going to have a pretty busy, probably the next 5 to 10 years would be my guess.
Well, I'm hoping.
All right. Good luck, and thanks for sitting down with me.
Well, thank you so much. Appreciate it.
Yeah.